It's just a nice, beautiful 645% over 4 years backtest on one single contract for the NASDAQ 100 E-mini futures. What's going on, everybody? It's Ryan here, CEO and head quant at happytrader.io. Today, we're going to be looking at the 45-minute backtest over the last 4 years. So from 2020 to 2024, year to date. So this is going to be for those of you who might be more hands off and maybe just want to take the larger trades. You can see that these trades span multiple days in many instances, sometimes almost an entire week of being in these trades. So what we're going to do is enable our long only strategy, which is our flagship backtesting strategy. And you can see that it puts a buy AI and sell AI. So it'll close the entry of the buy AI on the downtrend signal. And then we're just buying the market on the uptrend signal. Simple as pie, using the NQs. So this will be the E-mini NASDAQ 100 futures. We're going to hop right into the back test and not fluff this video up at all. Disclaimer, this is not financial advice. This is for educational purposes only. All right, so we're going to get into the back test. The first thing we want to do here is look at the margin requirements. So we're going to do a very realistic small account back test of just what would have happened if you just maintain margin, no scale ins, no scale outs. You can see that the margin requirement here is quite higher than the ES. So you can see the volatility when you're dealing with the NASDAQ 100 as opposed to the S&P 500. The NASDAQ 100 inherently is more volatile because it's mostly big tech. So this is something you may already know. So we're going to get right into it and use a $20,000 buffer per contract. So that's how we're going to execute this back test. So we're just going to set a $20,000 initial capital margin. We're not going to pyramid. So if we were to get two signals, which is very rare with Happy Trader, in the same direction successively, in the case of maybe a big news event or a Fed day or something like that, we're not going to play into that at all. We're just sticking to our normal uptrend and downtrend buy and close signals. And that's all there is to it. Now, commission, there's not going to be a lot of it. You might pay $1.50, $1.60, maybe $1.80 if you're getting absolutely pummeled with commissions by your broker. But a lot of brokerages are around the 150 mark per leg, so you can do your own math there. But since we're doing swing trading and we're not getting really down to the nitty gritty of the 5-10 minute charts, you're not going to have nearly as many trades and therefore way less commission. So this is going to be very attractive for someone with a small account that does not want to pay a lot of commissions. Also, just to preface this, the normal S&P 500 buy and hold return somewhere between 6 and 11% per year, compounding. So you can see that we're not going to do any sort of scaling in or out, just one single contract. And this is going to be some powerful stuff that hopefully is an eye opener for you. So we're going to go ahead and just eliminate the pyramiding, not enter the commission because there's just not a lot of trades. And let's change this to today. So we're going to do a full 4-year back test and then make sure everything is set appropriately, which it is. And we'll go ahead and run the back test through TradingView. And this is a great back test. You can see where it started, where it took its first trade was on 422, and it exited that trade on 423. You can see the span of the day ranges here. Some of these trades are very, very long. One other thing of note while we're looking at the trade log, this is something very important that I cannot mention in enough videos, is that you do not have to trade Happy Trader if you're a seasoned, skilled trader that has a different risk management type of position and you're trading a little bit tighter. You're getting large run-ups even on trades that are ultimately losing going signal to signal, right? So you can see that demonstrated. These are small ones, but a lot of times you'll get ones like this, like 56.90 on an $845 loser, 1285, so like 50% of what the loss would be. These are common, like 1/3 of what the loss would be. So if we go to the performance summary, you can see, we just have our net is the difference between the gross profit and loss, obviously. And if we go to our overview, you can see percent profitable, 36.96%, very in line with normal happy trader conventions. So that's going to be your win rate. So if you go into the list of trades, you're ultimately going to have more losing trades than winners. And that's what's going to throw you off. But because this is a long only strategy, if you're not staring at the screen, the drift is going to give you leverage, right? So you're going to have strings of winners, and then you're going to have winners that are huge compared to strings of losers, right? Especially on the 45-minute chart. And that's really how that works. So that's how you get your expectancy. You can see the graph here. Now, another potential negative here that you might want to watch out for, if you're starting with 20 grand and it looks like we had a drawdown to maybe 16 grand, that might be a situation where you might want to pad that account, and that'll skew your percent return slightly. But really, it's just to get you margined into one contract. So we're giving a little bit of a buffer. The real return is definitely in this range. It depends on how your account's structured, depends on your margin for your individual broker. So your results may vary depending on your margin requirements. Since we play nicely with Tradevate, we're not endorsed by them, nor are we an introducing broker. We're going off of 19,470. So you can see here, 645% over the last 4 years, not too shabby on 276 trades. So you're looking at maybe at most, let's say $400-500 in commissions there across the board. Not too bad. So that's, why we're not putting commission in. It varies by broker. It varies by if you have stop loss strategies and you're constantly getting in and out of trades on a tighter basis. That's going to be something that's going to change for you. Now, we're not using any stops. We're going from signal to signal. What we can do, what I like to do, is delta hedge. So you can take the original position. If it goes underwater, if it goes into the red here on the graph, you can delta hedge and then you can get up above water. So by delta hedging, just take the opposing side of the trade. Then when your initial core position gets back up over this hump, you can go ahead and set your delta hedge back up, and you can unwind that delta hedge while you're letting your trades play out. This is not something for the faint of heart. These drawdowns, like from 136K down to 87K, could make you think that the strategy isn't working. And then you just drill down even further, and you can see we get all the way down to 62K. So profit taking run ups on drawdowns, all things that you can do for sure. And then if you buy and hold and you diamond hand that sucker and pretend that you do not know what's happening in this account at all, you're going to have, at worst, on this particular backtest, a 53% drawdown. And you're going to have that backstop of a delta hedge, which is how I prefer to trade because I don't want to be stopping out on these ridges, right? Because there's no free lunch on Wall Street. So the tighter your risk management, the more prone you are and the more susceptible you are to the chop range of the futures market. And that's really just the way that it works. You have to pick whether you want to be a tighter trader or whether you just want to protect that principle. It's up to you how you want to use these signals. We have traders that scalp these signals. We have traders that buy call options on these signals. And we have traders that go down into lower time frames, but we're just focusing on a swing trading strategy, minimally active as far as 276 trades over the course of 4 years. Not too bad at all. Now we're going to be doing a lot more of these back tests. We're going to be doing a lot more on Bitcoin. We're going to be doing Ethereum and anything that's regulated, we're going to be looking at. And there's also going to be some big things coming. So you might want to stay locked in. And of course, you can visit us at happytrader.io to learn more. And again, my name's Ryan, the CEO and head quant here at Happy Trader, bringing you the back test for the NASDAQ E-mini futures. Last 4 years looks great, 645%, effectively outpacing and outperforming any hedge fund out there. And you'll be hard pressed to find better returns unless you're selling options premium or doing something extraordinarily risky like selling naked strangles or something like that. So stay locked, hit the subscribe button, the like button. It's all appreciated to get this type of information out in front of a lot of different investors who think the way that you do about the markets and are looking for the most alpha possible. Have a great day and happy trading.